Good morning, and welcome to the Bitcoin Street Journal Market Update. I'm your host, Anna, and today is Monday, February 23rd, 2026. This morning, we're navigating a market defined by stark contrasts and powerful undercurrents. We'll begin by dissecting Bitcoin's volatile surge past $64,000 and the subsequent market purge. Then we'll examine the diverging fortunes of major industry players, from Circle's impressive earnings to the immense pressure on crypto miners. We'll also look ahead, exploring institutional adoption on networks backed by Wall Street giants, and unpack the growing, dual-edged impact of artificial intelligence on both blockchain innovation and global cybersecurity. It's a complex picture, and we're here to bring it into focus for you. Let's begin with our deep dive into the market analysis and the headline that captured everyone's attention over the weekend: Bitcoin's powerful move to $64,000. This rally was fueled by a potent mix of spot buying and derivatives-led speculation, creating a wave of euphoric sentiment. But in the world of digital assets, such rapid ascents are often followed by equally dramatic corrections. And that is precisely what we saw. In the 24 hours that followed the peak, the market witnessed a brutal cleansing. A staggering $508 million in leveraged positions were liquidated. Now, what does this mean? Traders, particularly on derivatives exchanges, often use leverage, borrowed capital, to amplify their bets on the market's direction. They use instruments like perpetual futures contracts, which allow them to hold these positions indefinitely, as long as they maintain sufficient collateral. When the market moves sharply against them, as it did when Bitcoin's price fell, their collateral is no longer enough to cover the potential losses. The exchange's risk engine then automatically closes their position. This is a liquidation. This cascade of forced selling added downward pressure on the price, accelerating the correction. While painful for those involved, such events are often seen by market analysts as a necessary purge, washing out the excessive speculation and creating a more stable foundation for the next potential move. This volatility, however, masks a deeper, more nuanced story unfolding across the industry. It's truly a tale of two sectors. On one side, we have the story of profound maturation, exemplified by Circle Internet Financial, the company behind the USDC stablecoin. Circle has just posted incredibly strong earnings, and the source of this success is revealing. A significant portion of their revenue comes from interest earned on the high-quality liquid assets, like U.S. Treasury bills, that back their stablecoin reserves. This isn't some speculative, high-risk venture. It's a traditional, robust financial model applied to the digital asset space. USDC is becoming more than just a trading instrument. It's a foundational piece of infrastructure for the entire ecosystem, facilitating everything from cross-border payments to the complex operations of decentralized finance, or DeFi. Circle's success is a powerful signal that the industry is evolving, creating businesses with sustainable, real-world revenue streams that integrate seamlessly with mainstream finance. Now contrast that picture of stability and profit with the immense challenges facing the very heart of the Bitcoin network. The miners. These companies are being squeezed from two directions. First, by soaring global energy costs, which directly impact their primary operational expense. And second, by intensifying regulatory scrutiny. Governments around the world are taking a closer look at the environmental impact of proof-of-work mining and demanding greater financial transparency from publicly traded mining firms. This dual pressure is compressing profit margins to a breaking point for many operators, forcing them to reevaluate their entire business model. This brings us to the fascinating strategic divergence we're seeing in the mining sector, perfectly illustrated by Bitdeer. In a move that sent ripples through the industry, CEO Jihan Wu announced that Bitdeer had sold its entire Bitcoin treasury, all 943.1 BTC. This wasn't a fire sale driven by panic. It was a calculated strategic pivot. The capital is being used to acquire land for the construction of new data centers, not just for mining, but for the power-hungry demands of AI infrastructure. This cash-out-to-build strategy is a dramatic departure from the approach of competitors like Mara Holdings and Riot Platforms, who have famously built up massive Bitcoin reserves on their balance sheets, betting on long-term price appreciation. Bitdeer's move suggests a belief that in the current environment, the most valuable asset isn't necessarily digital gold, but the physical infrastructure that powers the next wave of technology, including both crypto and AI. This divergence in strategy signals a critical turning point for the mining industry as it grapples with its future. Now, let's broaden our lens and look at the institutional and technological trends shaping that future. A great place to start is the 2026 forecast from Coinbase Ventures, the investment arm of the exchange. Their report reads like a blueprint for the next 2 years of innovation. They see continued explosive growth in DeFi, particularly in more sophisticated products like decentralized perpetual futures and solutions for cross-chain liquidity, making it easier for capital to flow between different blockchain networks. Even more compelling is their focus on the rise of AI agents. These are autonomous programs that can make decisions and execute transactions on-chain based on predefined criteria, potentially managing everything from investment portfolios to complex supply chain logistics without human intervention. Finally, they highlight major advancements in privacy technology, especially zero-knowledge proofs, or ZK proofs. In simple terms, these are cryptographic methods that allow one party to prove to another that a statement is true, without revealing any of the underlying information. This technology could unlock secure private transactions and computations on public blockchains, a holy grail for enterprise and individual users alike. And this innovation isn't happening in a vacuum. The institutional engine is firing on all cylinders. A key indicator comes from the Canton Network, a blockchain consortium that reads like a who's who of Wall Street. Goldman Sachs, the DTC, and NASDAQ are all involved. The network recently reported that its burn-to-mint ratio has risen to 0.65. This metric is critical. It tracks the value of assets being burned or removed from the network for redemption in the real world versus new assets being minted or tokenized onto the network. A rising ratio indicates increasing utility and transaction velocity. The ultimate goal is a ratio exceeding 1.0, which would mean more value is being transacted and settled than is being created, putting the network in a deflationary state, a sign of a mature, highly utilized system. The fact that these financial giants are not just investing, but are acting as validators and actively participating in the network's governance shows a level of deep institutional commitment that goes far beyond surface-level interest. However, as we've mentioned, one of the most powerful forces shaping the future is AI, and it is proving to be a true double-edged sword. On the constructive side, we see news from the Israeli Defense Forces, which are training 20 new AI researchers for a specialized technology unit. This is a clear example of AI being integrated into the most critical, high-stakes operations imaginable. These researchers will work on projects like advanced audio classification to identify threats and sophisticated terrain mapping for autonomous systems, demonstrating AI's immense potential as a tool for security and efficiency. But there is a darker side. We must immediately pivot to a chilling report from cybersecurity firm Fortinet. They've uncovered a massive AI-driven hacking campaign that compromised over 600 firewalls across 55 countries. The attacker, believed to be financially motivated, used commercially available large language models, the same kind of technology behind tools like ChatGPT, to generate sophisticated attack plans and customized hacking scripts. The AI helped identify networks with exposed interfaces and weak credentials, automating what would have been a painstaking manual process. This incident is a stark wake-up call, demonstrating how accessible AI has dramatically lowered the barrier to entry for cybercrime, presenting an unprecedented and rapidly evolving threat to global infrastructure. Finally, let's look at some stories of ecosystem growth and a few market oddities. It's easy to get focused on the major tech hubs, but innovation is flourishing everywhere. In Israel, the city of Haifa is rapidly becoming a significant tech player, driven by investment from firms like High Center Ventures, which has already funded 24 startups. This is a crucial sign of a healthy, diversifying global ecosystem, moving beyond just consumer apps and into deep tech and industrial applications, creating a more resilient and geographically distributed foundation for the industry. And on the stranger side of the news, we have a cautionary tale about celebrity, hype, and the wild volatility of the token market. Pavel Durov, the founder of the messaging app Telegram, was recently gifted what was, at the time, $2 million worth of a particular token by its development team in a clear attempt to gain a high-profile endorsement. Durov pledged to hold the tokens until their value increased 100-fold. However, in a turn that surprises almost no one familiar with this space, the token's value promptly crashed, with his holdings now worth a mere $60,000. The story serves as a potent reminder of the ephemeral nature of hype-driven value, the immense risk of celebrity-endorsed tokens, and the near impossibility of making or trusting long-term holding promises in such a volatile environment. So, as we close out today's deep dive, what are the key takeaways? The market is sending us a complex set of signals. It is simultaneously maturing at an incredible pace, with firms like Circle building sustainable financial models and institutions like Goldman Sachs deeply embedding themselves in the infrastructure. At the same time, it remains a wild and volatile frontier, as evidenced by the massive liquidations and the strategic struggles of the mining sector. And looming over all of it is the transformative force of artificial intelligence, a technology that presents both our greatest opportunities for innovation and our most significant emerging threats. It's a landscape that demands careful navigation and constant analysis. That's all the time we have for today's Bitcoin Street Journal Market Update. Thank you for tuning in. I'm Anna, and we will be back tomorrow to help you make sense of it all.